Hello, everyone. Thank you for joining us today for NEPC's annual webinar, where we try to give you an update on what we see going on in the world. I'm Tim McCusker and delighted to welcome you here today. I'm joined by Sarah Samuels, our Chief Investment Officer, and Phil Nelson, our Head of Asset Allocation. And we're excited to share with you our views on markets. Just a few quick logistical items before we get into things. You have a Q&A box on the Zoom here. Feel free to type in questions. We will try to leave some time for questions at the end. We'll try to go about 35 minutes today in total and give you back a little bit of the hour that was scheduled. And then afterwards, we will have the slides and the recording available at nepc.com. So quickly, as we update you on NEPC, we try to really stay true to our roots with not much changing. And that starts with our mission to help our clients achieve their goals. We're really proud of the different clients that we have, the breadth of clients that we work with. Our goal at the end of the day is to help them achieve their goals and make a difference in the communities where they work. We have a vision of being our client's most trusted partner and using the great research platform that we have to identify great investment ideas, get those into our client portfolios to help them succeed and meet and exceed those objectives. And our strategy to do that is to improve our client outcomes. And if we're doing that, when our clients are doing well, our employees are really fulfilled because they're seeing the impact that our clients are having, and that leads to great success for NEPC and helps us have a great long-term business. That really hasn't changed over the 40 years that we've been around, and we're really proud of that. We're celebrating our 40th anniversary. It's a really exciting year here in 2026. You'll see some facts and figures on NEPC here on this page. Over 400 clients, almost 400 employees. We're really proud of the number of clients we have, that we're helping them oversee almost $2 trillion in assets. But really like that pie chart that we help different kinds of clients. And we think that that diversity of our client base helps make us better consultants, better advisors, better investors, because we're seeing different perspectives across client types and helping them solve different kinds of problems over the years. Really what we've tried to build is an organization that has the scale to cover the world, that gives our consultants the resources that they need to fill all of the investment buckets and solve all the investment problems that our clients have, and to have the time to work closely with our clients to really understand their objectives and their goals incredibly well and to deliver on those solutions. And we work with clients in different kinds of ways. We're happy to advise our clients and offer them solutions, but some clients ask us to take on more responsibility, whether it's delegated services, filling out the paperwork and putting the investment portfolios together, or OCIO services, where we really take over that whole portfolio. And we're really flexible in the models that we work with. Lastly, an update on Hightower. We developed a strategic partnership with Hightower last year, and it's been a really successful first year. Hightower is giving us operating autonomy to run our business, to work with our clients, but they've also helped us build the foundations over the last year to serve the advisor marketplace and the advisors at Hightower, so that we can broaden our client base and deliver those great investment results to a new set of clients, hopefully a new slice of the pie here that will hopefully lead to continued success for NEPC and allow us to invest back into our business to continue to be the best advisors out there. One of our big values and things we focus on is developing our people, helping them have great careers. And part of that is recognizing new partners each and every year. So really excited to welcome Aaron, Nick, Emma, McKaylee, and Brian into our partnership this year. And always love to see the diversity of the work that these folks do. We have folks from our defined contribution practice, from our corporate team, from our investment research team, and from our operations team. So these folks are delivering in lots of different ways to our clients to help them achieve their long-term goals. And then similarly, we recognize principals for their long-term impact on the business. Sujatha from our OCIO team, Colton and Nina from our research team, and then Shaheen from our operations team, all having really big positive impacts on our organization and on our clients. Lastly, Phil will talk about it at the end and give you a few more details, but hope to see many of you at our client conference in May. I think it's just nice to think about Boston in May right now when we look outside and see 2 feet of snow on the ground. So with that, I will turn it to Sarah to give you a little bit more of what's going on in markets.
Thank you, Tim. It's a pleasure to be with you all today. And just to reiterate what Tim said, that the capital that you steward is just so important and it makes the world go round. And it's our absolute honor to work with you to ensure that you can achieve your missions. So you heard a little bit of an organizational update from Tim. I'm going to drill down a level and share our strategy for investing in 2026 and beyond. And then I'm going to hand it over to Phil Nelson to talk about what we're seeing in the capital markets. So if we start with this page here, a lot of words on the page, but the punchline is this is a year to be prepared for volatility. How do we do that? We do that through diversification. This could be across strategy types, across geographical regions, across your underlying exposures. It could be being a liquidity provider. We believe that being a liquidity provider today will pay off. So this could mean continuing to commit to private markets with consistent pacing. It could mean being a lender through the credit markets, and it could mean participating in the secondary market as a buyer or a seller, which we'll talk about in a moment. Focusing on active management is very important at all times. We recognize that there have been some parts of the market that have been structurally challenged, universally challenged, given the unprecedented concentration that we've seen in benchmarks and the difficult lift that some managers have seen in outperforming indices. But we believe active management is critical and even more important when betas are expensive, which they are today across equities and credit. Stay close to your asset allocation targets, your strategic targets. So if you're an equity-centric investor, we recommend staying invested at target levels. And then finally, it's okay to be boring. This is not the time to reach for yield or step out on the risk spectrum. Our investment philosophy is to take risk when we're getting paid for it. Also in this vein, be sure to maintain liquid allocations in your portfolio. This could be cash, it could be treasuries, but something that you can invest to capitalize on dislocations should they occur and rebalance back to target, or to ensure that you have a rainy day fund to meet your spending obligations if something goes south. If we flip forward, we'll just go through some of the themes that we brought through our investment offsite a couple of weeks ago at NEPC across asset classes. So starting with marketable equities, and this is anything that's long only and equity long short hedge funds. The narrow market that we talked about really means that allocators and investors need to balance the trade-offs between index concentration and tracking error. What we've seen is that in the last couple of years, concentrated fundamental equity active strategies have been the most likely to underperform in the face of this unprecedented concentration. And we've seen that quant strategies or extension strategies have had lower tracking error relative to the indices and been more diversified. Within equity hedge funds, we're looking at healthcare and biotech. We think those present opportunities within those sectors. And we're also exploring the long books of some long short equity hedge funds. Staying in the equity vein, if we flip forward, within private equity, thankfully, in the fourth quarter, we've begun to see some green shoots in exit activity and distributions and overall deals getting done. This year, we introduced a framework to really guide clients how to build out a venture capital program, including a combination of seed, early stage, and late stage. Within buyouts, we continue to focus on lower middle markets. And then an overarching theme across private markets, and certainly in private equity, is that secondaries are on the rise. We saw a tremendous amount of secondary dollars being raised last year. There's a theme of pressure to transact, and this is among all market players, with both LP-led and GP-led secondaries or continuation vehicles increasing this year. Within credit, if we flip forward, we see real yield opportunities in the public realm with core and muni bonds. we're seeing a risk migration theme. So high yield is looking more high quality than it has in the past, while bank loans overall are looking lower in quality. We're seeing an increased connectivity or convergence between public and private credit. And this is showing up most frequently, most commonly in niche strategies, in these hybrid or crossover vehicles. We believe that credit hedge funds this year are going to be able to capitalize and arbitrage price dispersion with a particular focus on stressed corporate credit opportunities. If we flip forward to more diversifying oriented hedge fund strategies, as opposed to return seeking, we just touch on a few types of diversifying strategies here. So within global macro, we see a lot of opportunity with skilled managers, really good managers, who are able to take advantage of the volatility intra-markets. This is geopolitical volatility, trade volatility and uncertainty, rate volatility, being able to capitalize and arbitrage those movements based on the uncertainty in the markets today. For some clients, a fund of hedge fund allocation can make a lot of sense. We've seen this hold up much better with less volatility and be a more all-weather strategy with less headline risk. And then finally, event-driven hedge funds can capitalize on stressed issuers and restructuring opportunities, sort of how we talked about earlier in the credit space. Sticking with credit and moving out the liquidity spectrum to private credit, our theme here is really one of appearance versus reality, or what's happening above the line versus below the line. Basically, what we're saying here is that it may seem as though high-level market stats look healthy. Defaults are low. We're not seeing, a lot of major issues. But under the hood, things are a little more complex. And that complexity of how things are going within private credit brings a lot of opportunity. So we see value in smaller companies within direct lending as opposed to the big ones. We're looking for managers with restructuring skill who can come in and restructure not only financially, but also operationally. We believe we'll get paid for complexity risk. And finally, there are other strategies such as asset-based lending, and certainly secondaries are taking place here as well. The pressure to transact in private credit is significant. GPs need to unload some troubled assets, and the convergence theme here is very much at play. We've seen mergers and acquisitions among managers and the rise of semi-liquid funds. All this to say, be careful who you choose as your dance partner within private credit, and we spend a lot of time making sure that we have good dance partners. Shifting to real assets, and I'll just close out with real estate and real assets. Real estate has a good fundamental backdrop now. We think prices are bottoming out or have bottomed out, and we're really just waiting for transaction volume to pick up again. Within real assets, in summary, we encourage you to think outside of the AI box. So power demand is growing faster than power supply, and we see a lot of opportunities there. And then secondaries are a theme here as well. So with that was a very, very quick trip around the world with different asset classes and how we would recommend that you implement and play these themes today. With that, I'll turn it over to Phil to give a little more background on what's happening with the markets.
Great. Thanks, Sarah. And taking a step back and just kind of looking at what are we seeing in markets today. This is a tagline we used last year and seemed very appropriate for this year. And in many cases, a lot of the dynamics at play seem very similar from 12 months ago. And as we look at kind of the market conditions, I think overall we kind of view on the equity side that the market's not in a bubble. Valuations are above average. There's some frothiness in certain areas of the market, but it's hard to say there is a kind of macro bubble at play here across equity risk. Thinking about what are some of the outlier risks that maybe markets aren't necessarily paying attention to, or investors have kind of downgraded their minds, and we wanted to kind of just bring to the foreground inflation. When we think about inflation relative to where we were 4 or 5 years ago, inflation is much lower today. We're running below 3% inflation levels. Some of the recent prints have been 2.6, 2.7 type levels. But one of the, let's call it surprises that could really disrupt the market environment is if we start to see inflation tick back up again. I think one of the observations that us and many have is when you look at the U.S. economy, it's really geared to try to run hot over the next 18 months or so. And so we'll be obviously keeping a close eye on that as well. Also last year, we talked a bit about kind of what was the Fed's kind of policy bias. We clearly are starting to see that now, where a rate cutting cycle has begun. As we look at 2026, market expects the Fed to potentially have two Fed cuts over the course of the year. We just saw a pause yesterday, but there's a fair amount of whether it be kind of policy uncertainty or political uncertainty that markets are certainly keeping an eye on. And I think one of the things that kind of we and others be focused on is to what extent the Fed is adjusting rates in a measured fashion over the course of the year, which would certainly benefit keeping vol down across currencies and rates. And then lastly, I think when we think about the market environment, there's a lot of interconnected risks that are clearly starting to come together. And I think probably the most pronounced one is the wealth effect we're seeing for U.S. consumers. The U.S. consumer is the primary economic engine for the world when you think about level of consumer spending that comes out of the majority of wealth owners in this country. And that consumer spending is heavily influenced by the wealth that many of these folks are accruing. So that could be on the public equity front, private equity, crypto, housing markets. And the simple statement is if people feel wealthy, they tend to spend more. And so as markets continue to stay high or continue to move higher, that is a steady support for consumer spending that is obviously a pretty significant tailwind for the U.S. economy. And as we move forward here, we're going to take a kind of couple quick hits on U.S. equities. And I think we'll focus on that a bit. And as we look at kind of the U.S. equity complex, especially S&P 500, I think one of the big questions is, how should we be thinking about, let's call it the top 10 names in the S&P 5 relative to the rest of S&P 500? So looking at this, you can see performance of top 10 relative to equal weight in recent years, where almost a parabolic sweep up for 3-year returns for the top 10 names, clearly doing quite well. I think one of the questions that we've heard from many of our clients and we think about is this a call for mean reversion, or is there something structurally different amongst some of the largest tech names that appears more monopolistic or oligopoly-like in terms of their position and their ability to have significant earnings moats? And I think one of the pieces that we always like to think about is mean reversion over time does occur, but typically a catalyst is required. And I think as we look at things, what is the catalyst that would cause some of the pullback in some of those top 10 names? And it's hard to identify that quite at the moment here. And as we flip to the next slide here, you can see where we are with profit margins. And what we wanted to do is highlight really what's driving U.S. equity performance. And this is both kind of recent performance, but also in some of our capital market assumptions when we look, over the next 10 years or so. And, as stated earlier, we don't see equity markets in a bubble. Valuation levels are above average. But really, when you look inside kind of the financial outlook for the biggest U.S. companies in the world, or the biggest U.S. companies, you can see there's a pretty significant shift up in profit margins. So what we're looking at here is the weighted average of the profit margins for the top 10 names in the S&P 500 going back 30 years, and a big sweep up in recent years. So again, the question is this a cyclical high? Could you argue there's some sort of profit margin bubble built into the underlying economics of the largest corporations in the United States? Or is there some productivity boom or AI upgrade that's seeding the higher profit margins for some of these companies? As we flip forward, just to kind of give you a sense of where are we at from a valuation perspective across the world. And so this is kind of forward-looking PE multiples for some major equity markets. And everything's on the upper end of expensive. There's different levels of earnings growth priced in some of these markets, but nevertheless, you can say there's really no cheap asset out there that one can easily identify. And so as we think about equity positioning for the coming year, really kind of taking us back to let's be close to targets. We want to have exposure to active management, just being mindful of kind of tracking our exposures when we have under and overweights for especially those big 10 top 10 names in US indices. As we flip forward here, I think one piece that probably didn't require a chart and goes without saying, AI spending has been a huge benefit for the US economy in recent years. It's probably fair to say without the CapEx and AI-related spending over the last 2 or 3 years, there would be some form of kind of recessionary conditions for the US economy that we've seen at some point. So clearly a big tailwind for the economy and likely to continue. When we look at kind of leverage levels, we look at ability for corporations to increase debt issuance and raise leverage, ability for private markets to provide liquidity into data center spending or just in general construction costs. Still quite a bit of room to run. And I think also when we think about the conditions of the US economy with AI as a tailwind, but also thinking about some of the fiscal stimulus that we've seen from the tax cuts that were passed in 2025. So we have, lower taxes, a friendlier depreciation and expensing conditions in terms of what corporations and small businesses can do. On top of that, a friendlier regulatory environment, especially for the banking system. Add in the conditions of interest rates, especially in the short end, have been coming down in the US and maybe continue to do so. And the effect of which is you have a lot of conditions for the US economy to do well over the course of the next 12 to 18 months. It's clearly designed to run in that fashion. And so I think one of the things to keep an eye on, and I'm sure others will be looking at this, is how is inflation responding to above average economic growth over the course of 2026. I think that's a key thing for markets to be thinking about in the next kind of 12 months or so. Maybe taking a pivot here and just thinking from a strategic asset allocation outlook. Part of this is, thinking about capital market assumptions and, horizons over 10 years, 30 plus years as we think about when we, look to design strategic asset allocation structures for our clients. Let me just a couple, high level comments. On the equity side, valuation expansion, especially over, a 10-year period, is a real headwind to our equity return assumptions. Also, and it's a little bit of a commercial to kind of add on to what Sarah mentioned earlier, really encourage having a dedicated asset allocation target to safe haven fixed income to provide that liquidity support and liquidity needs that one needs. So as we flip the slide here, just to kind of take a quick look at what we're seeing with our return assumptions. Two time horizons that we publish. One is over a 10-year period, which is much more sensitive to kind of current valuations and current prices, if you will. So if you have an above average, valuation profile, you're going to amortize that above average valuation over a 120-month period. Versus when you look out over a 30-year return assumptions, especially on the equity side of the ledger, return assumptions are much more normalized and reflective of a kind of more normal, efficient frontier of as you add on risk, you should be compensated with returns. I think one comment on the fixed income side, for the most part, fixed income looks very normal. When you look at yields, you look at steepness of the curve, you look at real interest rates relative to a longer term history set. Fair value is probably the best way to describe fixed income. And I think for fixed income heavy investors, tilting towards that is a good prudent action for the course of this year. As we go to the next slide here, I just wanted to highlight when we talk about valuations and how one should be thinking about valuations over a time period. So this is looking at the returns of the S&P 500 over the last 10 and 30 years and breaking apart that return in terms of what are the drivers for the return? Is it earnings growth or is it valuation expansion? One should expect over time that earnings growth is the primary driver for equity returns, which makes sense, I think, for all of us intuitively. And so when you look at, the returns of the S&P 5 for the last 30 years, you can see the dominant share of that return really is coming from earnings growth. But when we look at over a 10-year period, there's a much bigger component of valuation that's benefited equity markets from the past 10 years. And as we look forward, potentially the next 10 to 15 years, that valuation premium will have to be given back slowly over time. So, said another way, for the last 10 plus years, we've probably been borrowing from returns from the future. And that is a tax that likely will come back over the next 100 plus months or so. So thinking about, how should, investors be thinking about kind of the market environment? And, there's no one investor, each investor is kind of unique in their own right. And I think one of the things that we try to identify is how should we be thinking about, different, kind of governance models. And so we're thinking about kind of, let's call it a high Sharpe ratio investor, or an investor that has a bias to fixed income. And, we encourage, holding greater liquidity. We encourage kind of tilting towards fixed income. The risk return benefits, especially in a shorter term time horizon, really are benefiting towards fixed income if that fits within your objectives. Then on the other side of the coin, as we think about kind of a total return investor, really looking to build wealth over time. As Sarah mentioned, embrace being a liquidity provider, putting money into markets that can grow over, multi-year time horizons. And thinking within the equity complex, looking to balance diversification of the earnings growth of the largest names in the world. So this is obviously the top 10 names, the S&P 5, Taiwan Semiconductors of the world that we see, some of the large tech names in Korea as well. We want exposures, though. We want earnings growth flowing through our portfolios, but we also want to be properly diversified. When we think about S&P 5, almost 40% of the S&P 5 is concentrated in the top 10 names. I think for all of us with a diversification bias, that makes us a little uncomfortable. So thinking about ways to balance out our equity exposure with value and quality, we think makes a lot of sense over the next several years. And then with that, also thinking about where areas of active management are interesting. And I think one of the areas is kind of looking at that kind of small cap and mid cap space, or maybe said in more cute fashion of, think of the space between the largest small caps and the smallest large caps. There's a lot of interesting companies in that space that are trading at, relatively favorable valuations, that are really strong companies. The market, frankly, is somewhat ignored. And, finding a good implementation method to access that, we think makes a lot of sense. So as we flip the slide here, going to look at, quickly, where are we seeing the earnings growth across the world? I think kind of simple statement to be had is when you have earnings growth, as a long-term investor, you want to hoard that earnings growth as much as possible. And I think one of the challenges is, how do we absorb the outsized earnings growth coming from some of the AI-related names, tech-related names, but balancing, proper calibration of diversification equity portfolio. And that's a challenge that we all grapple with. And kind of looking across here, kind of expectations for 2026, you can see kind of on the US side and the tech side, very strong levels of growth. And then interestingly, kind of some of that small mid-cap space I mentioned, expectations for a strong U.S. economy may be flowing through into the U.S. equity complex. And then also thinking about kind of more broadly around the world, you look at emerging markets, pricing in fairly strong earnings growth for 2026. But when you look through the details and start to ask, where's that growth coming from? Much of that also is related to the AI spending coming out of the US. So you think about the Taiwan Semiconductors, some of the Korean tech names, huge levels of earnings growth expected from those as CapEx continues to expand in the United States. So thinking about where exposures are, how much of the underlying factor exposures or underlying economics are actually fairly similar. And I think that's an important piece to kind of think about. And as we look at kind of the last couple of slides here, some of this, kind of fits kind of comments we've already had, but, just looking at some simple valuation frameworks of, where we are relative to the last 30, 40 years in terms of a valuation outlook. One simple way to do that is looking at the earnings yield in the S&P 500, which is essentially the inverse of the price to earnings multiple, and compare that to investment grade bond yields. When bond yields are very low over the last 10 years, close to zero or above, not too high, you had a fairly high kind of equity risk premium built into equities that one could harvest. And that's been narrowing quite a bit over the last, 2 or 3 years, a combination of rising interest rates, but also valuations moving higher. But again, back to the comments of, we do not think we're in kind of quote broad market equity bubble. And you can see that when you compare some of the earnings yield metrics for, S&P relative to what we were seeing in the late 90s, where you can see kind of some really kind of low levels, negative levels during that time. And then to kind of wrap up, just as a reminder, if you do have a question, please pop it in the Q&A box. We've got a couple folks that have already done so, and so we'll try to hit a quick round trip of questions for everybody. But also just a quick commercial for our investment conference. As Tim mentioned, we've got about 2 feet of snow outside here in Boston. I can promise by May it'll be much nicer. Hopefully the snow is melted by then, but would love for you to join us all. And I'm sure more information is coming in terms of details and agendas coming your way. So maybe as we kind of kick off the Q&A session, maybe just to start with you, Tim. I think one of the things that's come up that we get from many of our clients, and it came through in some of the questions we got, is just how should we be thinking about geopolitics? And so you obviously are talking to a lot of our clients, Tim. If you could share a little bit of kind of what are you hearing from clients and kind of their concerns geopolitics, and what are some things we're looking to do just to help kind of keep folks calm and kind of have a measured outlook in this type of market environment.
Thanks, Phil. Geopolitics come up in almost every client conversation that we have. We are in an environment now where we're seeing a shifting world regime. Some of the things that I think we took as the base case for the world for most of the last 40 plus years, globalization, cooperation, supply chains, very integrated, those are shifting. And it's not to say that globalization is going away, but we are definitely seeing a slower pace of globalization and a priority for many economies around the world to protect their self-interests. There's some long-term concerns around that. If you're prioritizing your own economy, that means you're not finding the lowest cost way to manufacture goods. So it may mean higher inflation. It may mean more currency volatility over time. In the near term, as we look at things, there's lots of concerning things happening in markets and in geopolitics. Markets tend to just blow right past the geopolitics. Think about some of the things that have happened just in 2026. We've got a South American country that has seen a removal of their president. We have a potential land grab or attempt to buy property that we haven't seen since the 1800s. These are really concerning things that we haven't seen in a long, long time. Yet market volatility remains very muted. Net markets are, I guess, essentially flat this year, but up a little bit overall. We're not seeing a big drawdown as a result of these things. So I think the big picture is to be really well diversified, be prepared for different outcomes, but focus on the long term and not overreact to some of this short-term noise.
Thanks, Tim. And as you said, we've seen examples of this in 2026 and also 2025 of if the markets do overreact, have the liquidity kind of buckets and liquidity capacity to be able to rebalance relatively quickly. Because I think the expectation is markets, tend to snap back, and they seemingly are snapping back quicker than ever before. Maybe to pivot from kind of public market framing to kind of thinking about private markets. Sarah, there's a lot of conversation around secondary markets and private markets. And I wonder if you could take a minute and just talk a little bit about kind of importance of secondaries and some of the activity that you're seeing and hearing from clients on that front.
Sure thing. Thanks, Phil. There is a lot of chatter about secondaries and a lot of activity. We saw $220 billion raised for secondary funds in 2025, which was quite a bit higher than any other year and certainly more than anyone expected. The punchline and the key takeaway is that secondaries are a primary tool now. For LPs, they've become a more common portfolio management tool. And for GPs, continuation vehicles have become very standard and a way for them to continue to hold assets while also providing liquidity to their investors to a certain extent. So this theme is prevalent across private markets. We all know that we have not seen the distributions and the exit activity that our models had forecasted for private markets. It's particularly exacerbated in certain parts of venture capital, but it has affected for every nook and cranny of the private markets. And so one thing that we're seeing lots of clients do is begin to think about, should I be pricing my portfolio? Is this secondaries are no longer a sort of a Hail Mary or an act of desperation. They've been destigmatized, and the secondary markets have become much more institutionalized. So it's still a lot of work to sell a portion of one's portfolio. But when we think about the opportunity cost that some of those longer dated funds are eating up on clients' balance sheets, in some cases, if there's a lot of remaining value left, our research shows that there is not a lot of upside when a fund is 12, 13, 14 years into its fund life, that mostly that return has been locked in. So we're continuing to see a lot of interest when it comes to how we would recommend that clients act on this. If you're interested in playing in the secondary market, the first would be to take a look at your portfolios and see what you have that is in long dated funds and see if there's a lot of remaining value left in those funds. We can help introduce you to a broker. We can help walk you through that process if that's of interest to you as an additional, add-on. The other thing that we recommend you do is think about if you want to be a liquidity provider, then you could be buying positions in the secondary market. And we recommend buying smaller positions and if you want to be a seller, to sell large ones. There's a lot of forced transaction and buying pressure on the part of the private markets in some cases where they have to put money to work. And so there is value to be had on both sides, but essentially it's sell large and buy small.
Great. Thanks, Sarah. And we want to be conscious of everyone's time, so maybe we'll just do a quick kind of run through of a couple remaining questions here that have come in. One was related to thoughts on U.S. dollar and volatility flowing through in terms of how we're thinking about portfolio construction. And I think one kind of quick piece of advice, from our perspective, we very well could see more volatility with U.S. dollar. Typically, with kind of geopolitics and political risk, they tend to transmit themselves through kind of global currencies. So expecting more currency vol is a reasonable assumption. But when we're thinking about making investments outside the United States, whether it's European private equity, non-U.S. public equities, we'd encourage to make the investment based on the thesis of the underlying cash flows of the asset, not based on the currencies. So moving away strictly from the dollar, for moving away from dollar sake is not something we'd encourage. We are not overly concerned with kind of the stability of the U.S. dollar complex. So again, focus on the investment thesis for the underlying asset when making investment decisions to move cash overseas. And second, just thinking about kind of the inflation outlook, the levels of our concern there, what are some areas that we should be thinking about outside of kind of the typical inflation sensitive areas? And I think two things at play here. One, equities tend to have a fairly strong inflation beta. So thinking about your inflation exposure through the context of an equity portfolio, I think is an important one. But also B, when you look at the kind of really strong rally that we've seen with gold over the last several years, obviously expressing some of the concern around kind of macro stability, but also the profile around, global government debt loads and kind of what's going on in terms of potential paths for inflation. And so holding that within a kind of diversified real assets mix, if it fits within your investment objectives, we think makes sense. So with that, I think we will wrap. And for those that did ask, there will be a copy of this presentation and recording that posted on NEPC's website. So feel free to watch us all again. And again, thank you everybody for joining, and have a great start to the year.